Hi, I'm Chance Finucane, Chief Investment Officer at Oxbow Advisors. Here's what caught our attention over the past month. First, investors have realized their projection of 6 rate cuts by the Federal Reserve in 2024 was too hopeful. Now it appears the Fed funds rate is expected to stay at 5% or higher at least through the summer. This provides a great baseline for investors. There's nothing wrong with a risk-free 5% annualized return while waiting to see if better opportunities arise. Prices in other asset classes are moving as well now that it appears inflation may hang around 3%. Treasury yields from the 2-year note all the way out to the 30-year bond are moving higher. If longer-term rates continue to rise, it could act as a headwind for the stock market. The price of oil is rising year-to-date as well. Rising interest rates and oil prices suggest to us that the macro backdrop has reached a more balanced state between inflation and interest rates moving lower versus higher. Now more than ever, it's important to keep balance in your portfolio and not be wedded to a specific economic outcome. The possibility of a soft landing for the economy has investors thinking about the last soft landing in 1994 and 1995 that started a 5-year epic bull market for stocks. There is a key difference though. Most of the stock gains from 1995 to 2000 came from expansion in valuation multiples. Today, it's a very different starting point with the forward price-to-earnings ratio of the S&P 500 above 20 times. We do not expect a repeat of that raging bull market in stocks. Another headwind for stocks this year is the dissipating benefit from fiscal stimulus by the U.S. government. The high government stimulus provided in 2023 surprised everyone, but that's expected to revert to a negative this year. Nvidia has been the story of the year so far, and its market cap has reached a staggering level. The company now has a greater market cap than the entire energy sector. This is despite its profits making up a fraction of those produced by the large energy businesses. This reminds us a bit of when Salesforce replaced ExxonMobil in the Dow Jones Index in August 2020. In the 3.5 years since that swap, Exxon's total return is 209% compared to Salesforce's 11%. The leap in market cap is due to Nvidia reporting record profit margins far beyond anything it's achieved in the past. The record margins make sense currently when you consider the large lead the company has over the competition for the latest semiconductor chips. We would not expect the margins to stay this high forever though. One thing to remember about Nvidia is its revenue growth tends to run in big cycles up and down. Tech investors pay close attention to revenue growth. They want to see growth accelerate, and they would become concerned when growth enters a downtrend. Nvidia's revenue growth either peaked last quarter or is about to peak in the current quarter. In the past, after previous revenue growth peaks, the stock continued to appreciate for about another 6 to 7 months, but then the share price declined by 50 to 70% during the down cycle. While it's been an outstanding holding for anyone that's owned it for the past 16 months, we would not advise trying to jump in and catch up today. Investors often find value in sectors that are ignored. Today, those are the commodity sectors. This chart looks at the percentage of capital investment projects in the S&P 500 represented by the tech sector versus the commodity sectors. It's best to be skeptical when a sector is considered hot and lots of new money is coming in to fund new projects. It often leads to oversupplied markets and profit declines. In the late 1990s, everyone wanted to own tech while commodities were ignored. Then commodities outperformed for the next decade. In the early 2010s, commodities were valued highly and tech was viewed skeptically. Tech has had an amazing run in the ensuing decade. Today, we're back to tech being loved and commodities shunned. This doesn't mean sell all your tech positions, but the picture does align with our inability to find undervalued tech stocks today. Instead, we have added a few energy positions recently to balance the stock portfolio. Last, Warren Buffett recently included a note in his latest annual letter to Berkshire Hathaway shareholders touching on his views about keeping some cash on hand, and it aligns with our approach to investing for the long run. Buffett says, "In most years, indeed in most decades, our caution will likely prove to be unneeded behavior, akin to an insurance policy on a fortress-like building thought to be fireproof. But Berkshire does not want to inflict permanent financial damage. Berkshire is built to last." We strive to invest in a manner that seeks outstanding opportunities, but never forgets the most important rule is protecting the portfolios against unexpected events that could happen in the economy or the financial markets in the years ahead. If you have any questions about this, please contact us. We like to provide the information we think is most valuable for investors. If you'd like to see more videos like this, please subscribe to our YouTube channel.